Damen und Herren, ich begrüße Sie recht herzlich nach dem Mittagessen zum zweiten Teil. The second part will be about methods, and alternative asset classes will be the third part. I will first give you an overview of the methods, then factor investing, introducing to the topic, and introducing to the active risk-based investing topic. Then afterwards, we will have two power speeches, two discussions about factor investing, and then a speech and a discussion about active risk-based investing. So if you speak about alternatives in investments, there are several dimensions. Alternative could mean alternative asset classes. That will be the next session. Could also mean alternative methods. One is big data, and this we'll discuss afterwards, an example, Alpha Cruncher. Now I focus on alternative strategies, which will be factor investing and active risk-based investing. So factor investing, here you see a slide from the last 3 months this year. We started here in January. What you see, the blue line is the MSCI World. And you see at the beginning in January, February, the drop, and then the recovery. And up here, you see several factor indices. When just looking at that, what do we observe? But first, the correlation between these factor investing methods and the asset classes is rather low. This is clearly not a proof. The second observation is simply that these factor indices generate some premium. And the third observation here is that the volatility of these factor investing indices is much lower than here on the MSCI World. So the question is, what are these factor investing indices here? So first, factors, they follow from empirical characteristics of assets. There is no such thing as a theory. That means you have to believe in the factors. So you have to believe that the past winners, buying them and selling the past losers, will also hold tomorrow and in the future. Now, there are different types of characteristics. We have value, momentum, carry, and so on. A factor strategy is a liquid trading strategy which implements what you observe in the data. Now, to construct such a strategy, the requirement is simply that. Let me explain that. So take a factor, momentum. Means buying past winners and selling the losers. So this factor, what will he have? He has a factor premium, lambda. Now, this factor premium should explain the risk premium of the assets on the left side. And if the beta is large, fine. If the beta is small, that's not good. Now, typically, you should not use one factor. There are many. And one requirement at the beginning is that these factors should be uncorrelated as much as possible. We have seen that in the chart before. That is this sum with the circle. So now we have, the goal is to construct a portfolio of factors which are correlated as big as possible, which explain as much as possible of the risk premium of the assets. Now, given that many use risk factor investing by adding that to the core portfolio, this stuff here should also be uncorrelated to the core portfolio. And the next condition is, this clearly makes an error. The error should be small. And the final condition in constructing such premiums is, this equation should hold in good and bad times. So that's what the whole industry produces and sells all the time. Now, this raises several questions. First, today in the literature there are about 300 factors. And this is simply ridiculous. This is a kind of destroying an industry. No one believes that there are 300 factors to explain the returns of the assets. Then the immediate second question is, give me the lucky factors. Since there is no theory, it's a kind of a search. Then if you have found the factors which in the past delivered positive risk premia, the natural question of an investor is how persistent will it be in the future? Then who should use factor investing? And the question which always is raised is, if everybody invests in factors, what happens to the premium? Well, it depends. If it's something which you are rewarded in equilibrium, it will survive. If it's a fantasy, it will evaporate. These are questions which investors typically ask, which are fundamental. The two gentlemen which speak afterwards here, these are questions from practice. Factor investment heavily depends on how it's implemented. Next one is here, the challenges. If you speak with client, what are the main challenges? And the challenges in factor investing, speaking with client, I think is much different than if providers of solution come with other solutions. The long-short debate. Should you implement factors long only or long short, which can be a problem for a certain type of investors? Summarizing, factor investing is an old story. It started in the 60s of last century with the capital asset pricing model, and then there's a revolution going on. So what we are speaking here, it's something where in economics there's a lot of experience of 50 to 60 years. And the interesting thing is, now it's a hot topic. Okay? But it's an old story. It's not fintech or something like that. It's old. But now it's becoming very important. The second type of presentations is active risk-based investing. There, the starting point is completely different. There, the start is that optimal asset allocation, say starting with Markowitz, has many weaknesses. Many asset management don't use it because either what comes out is not robust, has a high or strong estimation risk, and so on. The dot-com crisis in 2008 showed, for example, that the diversification which comes out of these optimizations can evaporate. Risk-based investing takes a radical different approach. They say it's not performance first, but risk management. And we start without any optimization. So there is not based on an economic optimization as in the Markowitz models or any other models, because there are these weaknesses. And then risk-based investment explicitly considers the risk dimension and only implicit the return dimension. So these are the two principles. No optimization a la Markowitz or whatever, but the goal is allocate a risk budget to the risk contribution of each asset and then solve the program. This approach is heuristic. Many economists would say, why does this work? Practitioners will say, because it makes sense. An economist will say, but not an economic one. Okay, but if it works and it makes sense, who cares about the economy? So it's a heuristic approach. And as in the factor investment topic, there are many different ways, as we will see, how you can implement it. It is used for risk-based indexing, risk parity multi-asset classes, and other alternative investments. And as for factor investing, there are a lot of questions. First one, who should use this risk-based investment? People ask, is it only about risk? Low risk and hence low return? No, but it looks like at the beginning, because you always speak only about risk implicitly. Then something which is disturbing for many investors is, how can I put my views into that approach? It looks like a passive approach. Jérôme will show you that's not true. Since you control the risk, you have leverage. This works only because there's leverage. Question. And it's a kind of momentum. So this is basically a momentum strategy. And how can we integrate the views? These are the questions of the speakers which will follow.